There is this argument I hear often, and sometimes from economists as well, because if rupee falls, inflation will go up. Well, if you have to bring down imports, if inflation doesn't go up, no one is going to stop consuming imported avocados because you tell them to, right? I mean, they will only maybe switch to domestic avocados if the imported avocados are much more expensive, or imported apples are much more expensive, right? So I think the weakening of the rupee is not a happy thing to do, but is the best solution in the current environment.
Hi, I'm Shoma Chaudhury. Thanks for watching Inquiry. Over the last few weeks, there are two spiraling crises in India. On the one hand, there's a growing and disturbing communalism, and on the other, there are big economic clouds brewing. From the government's sudden ban on wheat exports to the RBI's raise in interest rates, an alarming rise in inflation, low demand, low growth, high unemployment rates, tense relations between center and state, excess capacity, and profit for the few. Basically, critics of the government like economist Ratin Roy and former finance ministers like Mr. Chidambaram and Yashwant Sinha say that India is suffering a silent heart attack. On the other hand, the government claims that the fundamentals of the economy is robust and that the crisis is really driven by global forces like the pandemic and the Ukrainian war, and that their response is good enough. In fact, just a couple of days ago, the chief economic advisor, Anantha Nageshwaran, said that India is still poised to cross the $5 trillion mark in just 3 or 4 years. The IMF and The Economist have also given fairly optimistic assessments of India. So why is there such radically different readings of the Indian economy? Between inflated claims and inflated fears, is there any objective truth? And why has data begun to feel like detective fiction? To address these issues, I have a reputed economist on the show today. Neelkanth Mishra is an economist with Credit Suisse and part of the Prime Minister's Advisory Council. He has the ears of the government, but it'll be interesting to hear his take on all these issues as a professional economist. It's a privilege to have you on the show, Neil. Thank you very much for joining me on Inquiry.
Pleasure being here. Thank you for having me.
So Neil, I wanted to start with the questions on, which is preoccupying everyone, which is India's growth figures and inflation figures. Just today, the RBI has again increased the rates. And I believe the ECB is going to meet on June 10th. And then, the Fed is going to meet on June 15th, where there's apparently going to be a 50% hike. So there's a lot of fear that, the whole world is moving towards recession, stagflation, and that India's on that brink as well. So how do you see this? And how do you think the government should handle this tightrope between growth and controlling inflation?
So let's start with the global problem. So there was an excessive stimulus that the US gave in response to the COVID lockdowns, which created, I think, disruptions in supply chains, which were very global in nature. At one point, their own ports were unable to handle the workload, and 4% of global shipping capacity was waiting outside US ports. And that meant that shipping costs started to go up. There was a shortage of ships and all that. But the good thing is that that cycle is now inverting. So US fiscal deficit on a 3-month rolling basis is the lowest now it has been since June 2019. So a lot of that excess, I think there will be some more time before it kind of drains out of the system, but the process and the path is now clear. But then in February, when the Russia-Ukraine conflict started, what it did was it took out food and energy supplies from the world market. Now, the thing about energy and dense forms of energy is that without energy, you cannot grow. And fiscal and monetary interventions can help redistribute in the sense that the country that gives the strongest fiscal support to, say, petrol and diesel consumption will consume a lot more of it. But the reality is that the world economy needs to now operate lower than it would have without the disruption in supplies.
Mhm.
So some kind of growth risk for the world is, I think, quite clear. I think it is being exacerbated. And what I would add to the concerns that you highlighted would be the Chinese COVID lockdowns. We have to remember that versus 2008, which was the last big global recession that the world saw, China's economic size is now much larger. So in our calculations, a 4-month COVID lockdown in China has as much impact on global goods demand than a proper US recession. And therefore, there are many growth headwinds for the world. And it is a very tricky situation for central bankers the world over to manage inflation expectations, manage inflation. Coming to India, the imported side of inflation, I think one part of it, which is the metals and semiconductors and some of those, I think the path and the process of easing is very clear. On the energy side, I don't think things will ease off very quickly. We all would like to. I mean, I would also hope that is kind of ends here and starts to ease from here. But the way governments are responding, so we calculated there's more than $300 billion of energy subsidies that are being given by the governments world over. And everyone from Japan, China, India, Italy, US, Australia, everyone is giving subsidies. So the demand destruction because of high prices of energy is not happening. And supply addition is also not happening because the suppliers are unclear how long this lasts. So energy prices can remain quite elevated. So in this environment, how should the government and the RBI act? And I think that the biggest challenge for India right now is the balance of payments deficit, right? So we've always had a current account deficit, which means that we consume more than we produce. Because what we import, which is dense forms of energy, is now becoming so much more expensive, we need to bring down imports, right? And if we try doing that only through energy, it will be challenging. So we need to bring down all imports. And I think the best way out of this is a much weaker rupee. And I think over a period of time, the policymakers will converge on this topic. And I think we will see weakness in the currency, which is, I think, the best method. The second best method is to raise interest rates and slow down the economy. I don't think that is prudent. What we have seen so far is more a normalization, right? So during COVID, you had very brutal cuts to interest rates because the economy was in very frail shape. Now the economy is reviving. And in fact, our growth rates could be substantially higher than what the RBI is forecasting.
So, you've opened up many strands there. So I just want to go step by step, just first to understand the India context, that when you said that, this spike in inflation, let's leave the war and COVID out of it, but was the response of the central banks was to really infuse the system with a lot of money. In India, it took a different route, so the IMF and in fact, a lot of economists across the world, even within here, even the former finance ministers, etc., all advising the government to infuse much more money into the hands of people. And it didn't. It kept focusing on the fiscal deficit. It focused on capital expenditure. So then, even before we started importing this global inflation, there was already a lot of stress in India's system. The inflation was already high, petrol prices, diesel prices were already high, food prices were going up. So, just looking in the India context and government response, do you think the government has been making the right moves? Are there some miscalculations it's done? And there's also been a lot of commentary on the fact that maybe even the RBI was caught sleeping. Mr. Chidambaram has said that because the government was just passing on high fuel prices to consumers, food prices were high, etc. Taxes are very high, GDP is very high, so that it's almost created this domestic inflation. Do you think any of those criticisms are fair? And what do you think the government's done right? What do you think it's done miscalculated on?
So let's view it objectively as what drives inflation, right? So inflation comes when demand exceeds supply. So the usual causes of inflation are that a government prints a lot of money and distributes it to people, the production capacity of that economy and the world do not go up. And therefore, people compete and they have more money, so the prices go up, right? So that's actually how most inflation can be explained. So the question to ask is, what really happened in India before this disruption was happening, and why was inflation going up? I think the supply erosion that happened in India because of the lockdowns. Remember that we had very harsh lockdowns, right? Especially in the first part of the pandemic, because we had very little medical infrastructure and so on and so forth. So I think health was prioritized over the economy. And what happened, I think, was that the supply got more damaged than demand. And to a large extent, the government's fiscal response was almost non-existent, right? So basically, the government made sure that no one was hungry, and that whatever health expenditure had to be done has to be done. And beyond that, they realized that perhaps it was going to be too leaky or too inappropriate. It's very hard to target. And if you see, on those counts, they've been proven right. The criticism of the US government now, in hindsight, is that the stimulus they gave was too excessive and too undirected, right? So even the rich were getting stimulus checks and all that. Now, I think the opening up of the economy, the fact that so much of the workforce is now coming back. If you look at Narega demand is, I think, slightly imperfect, but the best indicator of joblessness. I mean, you have to be very desperate to be working for 200 rupees a day, right? So in Narega, the excess demand had gone to 2 crore at one point. In April, it had fallen to about 20 lakhs. So that labor is now starting to come back into the market. So supplies are now adjusting and coming back. And I think there are serious data issues with our inflation as well. And again, we have to understand that during the pandemic, to expect, and during lockdowns, to expect that all of the investigators were actually going out to remote schools and movie theaters and collecting right data. For example, in the month of May last year, the inflation in education and recreation shot up.
Right.
And you would wonder, when everything was shut, when all schools were shut, it was the most aggressive of the Delta waves that we saw. And how could inflation have been going up, right? And I think that there have been issues with our data as well, which someone needs to investigate. I don't have the ability to, or even the access to that data.
But I was going to ask you about, what they call the policy software. There's not even minimum agreement on so much data, not even GDP data now, employment, labor participation.
GDP has always been dicey. So if you people have criticized the 2012 series. I mean, they have no idea how bad the previous ones were, right? So India statistics, I think, is a whole different debate. But what I'm saying is that the most sticky form of inflation, right? So the most sticky form of inflation is wage inflation, and that inflation has not gone up, right? So the rural wage surveys that are conducted, it's, again, I wish it was published sooner than it is, but with a lag of 3-4 months, but that there is absolutely no inflation visible there. There was this wave of inflation because for 2 years, the onion crop in October got destroyed because of a delayed monsoon withdrawal, right? So 2019 and 2020. So there are some very idiosyncratic things. For example, telecom, right? So telecom was seeing a complete price war from 2016 onwards. And then around 2019-20, there's 3 players were left. Finally, it was decided that, okay, there will be 3 private players. And then the ARPUs, the average revenue per user, have been hiked steadily. So if you remove some of those idiosyncratic things, there wasn't evidence of sustained sticky inflation pressures in India.
So, just to, because again, we've opened new strands, which are all triggering me to ask you questions. But just to come back to my original question, you're saying broadly, you feel that during this very difficult time, that the government's responses have by and large been, have been commensurate, and that you think they've been wise, and that India is in a better place. For instance, Mr. K. Subramaniam, who was the former chief economic advisor, he was pointing back to the condition India was in 2008 after the global financial crisis. And he said, actually, inflation figures were much higher, the deficit was much higher, so altogether, he said the economy was much more precarious than what India is in right now. So as just a professional economist, do you think that that's a correct assertion?
See, what happened around 2008-9 was a whole different ballgame, right? So there was an overheated global economy, which was growing way faster than it could sustain. We were running out of commodities. And then 2009-10 onward, China gave a massive infrastructure stimulus. Then India gave a pay commission hike, which raised the central and state government wages and pensions by 2.5% of GDP. Now imagine a permanent hike, right? So if you of course run your own thing, but even if I get a big bonus, I know it's only for 1 year, right? But imagine my salary doubling, and then I'm being told that for the rest of my life and my lifelong pension will be high. The consumption boost it gives, and therefore our current account went through the roof. So it was a very different environment. In this setup, I must say that while we were in the midst of the lockdown, I think the debate in policymaking circles was that how big should the stimulus be, right? So any sensible person would have said first figure out what is the permanent damage to GDP and try to fill it up. What I think the US erred in is that they looked at not the permanent damage, but the current damage. See, if you lock people down, obviously GDP will fall. Yeah. You cannot try to create a fiscal stimulus to plug that hole, because once you open it up, people will come back and work, right? And so I think in trying to decide that, before India's policymakers could even decide how big the stimulus should be and what would be a right stimulus which will have low leakage, which we can afford to have, where our currency won't come under attack, by the time that the lockdowns started lifting and I think the economy. And so we were fortunate that the permanent scars, economic scars in the economy were not very deep. And so we've come out fine. In fact, if you see our real GDP, if this energy shock had not happened, we would have been within 5% of our pre-pandemic path in real GDP. And actually, given the high inflation, we are already at a pre-pandemic path in terms of nominal GDP. Okay. Taxes are doing well. So I think by and large, I would say that by deciding to do things they were sure about, the government turned out to be much wiser than the US government.
Okay. So that's an interesting thing you're saying, because, like I was saying, nowadays, reading about the economy or trying to understand the economy is like a detective fiction, because there's just so many competing interpretations of it. You really wonder who done it, and whether there's even a murder or not a murder is in contention, So it's just so, and that brings us back to the data point, which I'll raise later. But there are 2-3 things here. One is about the growth. And before that, you said many policymakers will finally converge on the idea that the depreciation of the rupee is probably a good thing. Now, that's again goes a counter wisdom to what we all understand, or say we as Indians are really worrying about the rupee going down. But, both you and Sajid Chinoy are part of the Prime Minister's Advisory Council. He wrote an article about that. You're asserting this. So just in simple terms, so that even a lay audience can understand, can you explain again why lower rupee is going to be good for us?
So
let me put 2 questions there. One, will it be good for the macroeconomy, overall, what governments have to worry about, deficits, etc. But will that create a lot of pain for ordinary citizens? If you can explain it in both ways.
Yeah, so no, it is not a good option, but there are no good options, right? See, the parallel I give is that if you think about a household, And if the country is a household, right, it is like a gigantic household. And a current account deficit means that you are consuming more than you are producing, right? So it's like a household, and in everyone's extended family, there is some cousin or uncle who doesn't earn, just keeps consuming. Ancestral land is being sold, and all of that, right? So it is not exactly the same, but somewhat
The
similar,
same
right?
parallel.
So yeah, so a current account deficit means you're consuming more than you're producing, right? So suppose the household is consuming 120 and producing 100. So 20 rupees has to come from somewhere. That 20 rupees is either external commercial borrowing, meaning companies from India go and borrow dollars, or we sell assets. So most of our best quality companies are owned by foreigners, right? So the best car company, the best consumer company, the best banks, they're all owned by foreigners. There's a lot of FDI, which is all good, right? It's helping us grow faster, but that's how the CAD is funded. The current account deficit is funded. Now, in this steady state equilibrium, suppose the price of one import goes up, right? So that 120 becomes 130. Now you need to find out a way of selling 10 rupees or more land. Now you may not have that much land, which is one problem. Second, if you go out with that much land, you won't get the right price. So you have to bring down your consumption. So 130 has to be brought down to 120 because there is no other way to sustain it. So there is no good option. The least bad option is what we are looking at. Now, how do you bring down imports? Sorry, you had a question?
No. I was.
Yeah. So there is. So how do you bring it down, right? And you can choose to bring down only the item which became more expensive, in this case, energy. But then what that would necessitate is making local energy very expensive. And that would be very damaging to growth, right? So then if you make energy, say if oil prices have gone up by 50%, well, now they're up by 70%. So if you made oil prices on a like-to-like basis 70% more expensive so that energy demand came down, their GDP would just crater, right? So you can't do that. So the second best option is to get more capital. So somehow go and get maybe more NRI deposits, get India included in the global bond indices. So $30-40 billion comes in. But if you're not willing to do that, then you need to bring down your imports. There is no other solution. Now, to bring down imports, the most appropriate mechanism is to let the rupee weaken. So unless the imported avocados, unless the imported blueberries, the imported 2 lakh rupee iPhones become more expensive, their demand is not going to slow. And when the rupee weakens, some of your exports become more competitive as well. In a slowing global economy, I think that's not a bad thing to have. So which is why this is the best solution. The second solution would be to slow down the whole economy, which is what higher interest rates will do, right? So for example, if you raise rates, and see, the current rate hikes are not excessive, right? Current rate hikes are mostly a normalization to pre-COVID levels. But if, say, suppose you go from 4.9 to, say, 6.5, right, or 7. I'm not saying it should go there. Suppose you do that. Now, your mortgage rates start spiking up. Now, when you build a house in India, only 10 to 15% of the value of that construction is imported, right? So it's the coking coal and the steel that you're using, that saria, the TMT rebars, the thermal coal that you use for cement, making cement. Other than that, everything is domestic. So to control 15 rupees of import, you are destroying 100 rupees of construction value. So the GDP impact is much worse. So there is this argument I hear often, and sometimes from economists as well, because if rupee falls, inflation will go up. Well, if you have to bring down imports, if inflation doesn't go up, no one is going to stop consuming imported avocados because you tell them to, right? They will only maybe switch to domestic avocados if the imported avocados are much more expensive, or imported apples are much more expensive, right? So So I think the weakening of the rupee is not a happy thing to do, but is the best solution in the current environment.
So, we'd go too deep into this if I started playing back to you all the conventional wisdom. Like I said, in most people's mind, your own currency dropping is like a really bad signal, and it creates fear. But that's the conventional wisdom. You're giving another new interpretation of it. So I'll leave that one there. But when you're saying that India is in a fairly good place, that the government took wise decisions, the growth figures again are a matter of huge contention. So one is, so even on growth, I have two questions. One is that if everything you're saying is about slowing down growth, what are going to be the long-term repercussions for an economy that's already in trouble? And that's the question I wanted to ask you, that one, there's a contention over the growth figures. Like last week when the NSO figures came out, again, it was like, there were so many interpretations of it that ordinary people can't understand whether we are okay or not okay. The government was saying it looks good, it's 8.5, the IMF, the World Bank, everyone said India is one of the, stronger economies. We are the fifth largest. We're well on our, the government is asserting we're well on our way to being a 5 trillion economy. So there's that narrative. On the other hand, again, whether it's Mr. Chidambaram or Ratan Roy or many other economists are pointing to the fact that quarter by quarter, there's been a deep slide in growth figures. So from 20, it went to 13, from 20, it went to 8 to 5 to 4.1 last quarter. And so they're putting the spotlight on that. And then there's the other argument is that even if you just said that our growth figures are now more or less back to pre-pandemic, then the critiquers would say that forget about war, COVID, inflation, global problems. Pre all of this, in 2019, the economy was already in a lot of trouble and we were growing at 2.5% or something, So again, I'm asking you to assess for us that in how badly off is the Indian economy, not just in this circumstance, but if after all this, we're really back to just being a country growing at 2.5, then we are now trying to further deaccelerate even that growth. It sounds a very, very worrying situation to me, who's not an economist,
No, I don't think 2.5 and lower is the outlook. So, so let's see what was happening pre-COVID, right? So pre-COVID, since 2012, right? So 2012 onwards, the construction industry in India, so the dwelling construction, I call it dwelling because it includes residential and non-residential dwellings, right? So office and residential. That dwelling construction from 2012 to 2020, and I'm sure it fell in 21 as well, I'm talking fiscal years here, it fell by 5.5% of GDP, right? And it is something that should have been growing because, India's
housing demands are huge.
The housing demand should be growing, right? I mean, the number of households is expanding at 2.5% a year. You need more pakka houses, you need bigger houses, you need better quality houses. So construction should be growing. It wasn't. And in fact, in nominal terms, residential dwelling construction was flat for 8 years. In real terms, it just collapsed. Now, that in our calculation was a more than 1% a year drag on GDP growth. After almost 8-10 years of time correction real estate prices and clearance of inventory that was built in 2010 to 12, we are now starting to see the real estate market improve, right? It is improving a lot more in Hyderabad, Pune, Bangalore, and all of that, in pockets of Mumbai. Maybe not so much in Gurgaon right now, but it is starting to show signs of recovery. And that, I think, just the removal of the drag will mean that the economy does well. Then the 2018 failure of IL&FS and the non-banking finance company freeze that so they started slowing down because the bond market wouldn't give them a lot of funding. That drove a very sharp decline in inventories in India. So because if the wholesaler, the distributor do not have funding, I mean, they don't get working capital, the banks are not, or the NBFCs are not giving them loans, then they bring down the inventory that they hold. So the manufacturer, and remember that GDP is all about output. So if you draw down inventory, it's bad for GDP. You rebuild inventory, it is good for GDP. So the rebuilding of inventory was expected to happen in 2020, because around that time was when the NBFCs were starting to heal. And remember that autos, which are a very large part of India's industrial production, were going through a double transition, BS4 to BS6. And where prices were expected to go up by 50%, they did go up by 50% in most products. And the whole supply chain had to be emptied out. So when that happens, the GDP gets very badly impacted. And that 2.5-3% that for that March quarter, remember that last 15 days was also the pandemic lockdown, right? So 2020 calendar was when all of these cycles were expected to turn up. The real estate cycle, the NBFC funding, and the auto construction. But then the pandemic hit. Now we are likely to see a refueling or replenishing of the auto supply chains. We are likely to see a construction revival in residential dwellings. And we are now seeing a financial system which is in very healthy shape. The bond markets are functioning, and things are quite fine. Plus, we are seeing a revival in manufacturing exports. We are seeing very strong growth in services exports. And all of these things, and in manufacturing exports, again, this is something that...
Stop you there. Yeah, I was just going to pick on the manufacturing, because this other story you're telling, now again, it's speculative because all of this was supposed to replenish. It hasn't replenished. Yes. But the manufacturing, again, I was going to say, it's so difficult, Neil, because, if I read someone else, they'll say manufacturing is flat, it's not going up. And then if you say it's going up, I look like, I don't know how to take that, like.
No, but you look at India's manufacturing exports, right? So last 12 months, manufacturing exports are $434 billion. Now, that number is hard cash of exports that have come in, right? And for almost a decade, it was stuck in the 320, I would say actually 270 to $320 billion range.
I read that figure, that it's $400 billion now, our export figure.
The last 12 months is 434 now, right? So it was 400, but if our job is to keep abreast of current data, so I'm including May exports as well. So the last 12 months is 434, and some of it is, I think, price. So like steel prices have gone up, rice prices have gone up, wheat prices have gone up and all that. But if you dig down deeper, you will find there are very encouraging trends in electronics exports. India last year did record high exports of smartphones. And I think the target for the next 5 years for the government is to grow that like 5x. Whether that happens or not, time will tell, but at least the numbers are real, right? There's no denying that. In specialty chemicals, there are so many Indian companies that have now built up scale, and now they're starting to invest and grow on their own. In apparel, there is such strong demand that after 50% growth last year, companies are being asked to increase allocations to global buyers by 30, 40, 50%. So there are supply chains where there is very strong evidence of India's exports on the manufacturing side doing very well. And then we come to services exports, right? So services exports have also done very well. A lot of that is, again, pricing gains, in the sense that, when IT engineers in India get wage hikes, and if it is a company which is a global software major or a global bank like ours, which is running an offshore center here, it is cost plus. So our net services exports have risen from, I think, about $130 billion to close to a $160 billion number. So I think there are many drivers of growth as the world keeps trying to build new software, because now there's going to be software in cars, there's going to be software in washing machines, there's software everywhere now, right? And you need software engineers. And where do you find software engineers? They have to come to India. And we have a large pool of engineers. So So I think the pessimism on growth, if you set aside the political posturing, which I think both sides will have their own things to say on that. I work in markets. I advise investors, and so if I keep giving wrong advice, I won't have a job. So we need to be objective about what are the things that are anticipated and what we call priced in, and what are the things where there can be a positive surprise. And I think the positive surprises in the Indian economy can come from dwelling construction, from manufacturing exports, from services exports, from state government spending. Again, these are things that people have not sort of assimilated. In the worst affected part of the economy during the lockdowns was the government, because you and I can work from home, but governments can't work from home, right? And you've seen them from up close. Everything is about files, physical files. Babu file lana. There is no Babu and there's no file if you're sitting at home, right? So the point is that government expenditure, state government expenditure in particular, had come to almost a standstill. And you see what has happened in the last 4 months as the economies have opened up. Partly it is, I think, the willingness to, everyone wants to spend, right? Their incentive is to spend because it is everyone benefits when they spend, and they were unable to. And so every single road in Mumbai has been dug up. Now, some of it is necessary because 2 years of maintenance had not happened. Some of it could be for laying some fiber optic cable or whatever. But this is as pure a Keynesian stimulus as you can think of, right? As Keynes had said, right? You would dig a hole and fill it up at GDP. I don't think the people who are digging our roads in Mumbai are reading Keynes, but the impact is the same.
Right. So that's the government on just infrastructure push. You're saying that there's been so much spending by state governments and the central government. So
in the last 4-5 months, and I think this will sustain, because remember that in February, the government cash balance with RBI, because RBI is the banker of the government, was 5.5 trillion rupees, 5.5 lakh crores. A normal cash balance is more in the range of 0.5 to 1 trillion rupees, right? Because of course, like any household, you don't want to keep all the cash in the bank, right? So the reason they had so much was that they were borrowing, they were getting taxes, but they were unable to spend.
Yeah.
So the constraint on spending was not that of fiscal sort of resources. The constraint was the actual ability to execute. And I think with the lifting of lockdowns, that has changed as well. And I think as these things play out, we will see the economy, the growth is something that I wish the high energy costs were not a headwind, because that's a big problem. But I think the growth numbers, the consensus is now at 7.4% real for this fiscal year, fiscal 23. I think that it could be well above 9% real growth. Okay.
So I'm going to ask one or two more questions on growth because there's so many others to ask. But just when you say 7.2 or 7.5 are the accepted growth rate, it could be better. But when you say that, is it just the bounce back from an almost comatose COVID lockdown economy? Or does that mean that from the contraction that we were in, we've just come back to zero? Or does that mean that we are actually growing at 7.5?
No. So which is why I disagree with the 7.5 number. Right? The 7.5 assumes that if you see the RBI's forecast, which is slightly below consensus right now, so the implied growth rate in the fourth quarter, which is March 23 quarter, is 4%.
Yeah.
I don't think it's going to be anywhere as low as that, right? So there is a base effect, right? So remember that April, May, June last year was terrible, right? So and we had the Delta wave lockdowns and the second wave, and it was horrifying. And so including that base, if someone is projecting 7.2 or say consensus at 7.4, I think they are building in on a steady state basis more like 4.5-5% growth for the rest of the year. Right. So if you move beyond the June quarter, you're talking about a very low GDP growth number, and which is where I disagree. I think the economy is in actually much better shape than people are forecasting.
Okay. So, like I said, that's, it's interesting to hear you say that. As you said, you can't afford to politically posture. So, it's a more objective assessment of where we're at. And you've been giving very granular examples. So, I'm not going to presume to respond to that. But then the other question that comes to me, Neil, is that if you're feeling this optimistic, if the government has that much reserves with RBI, you said exports, and that's a figure I've seen everywhere, 434 billion. It's the best it's been. Tax collection has been very high. GST, all of this are good markers. And so it allows the government to spend a lot on welfare, and I think one of the things that the government really has invested in, it may be the tech infrastructure that the previous Congress government put in place, but this government has been using that. So there's this new phrase of tech welfare delivery, and so the government has put out a lot over COVID, etc., even on basic food and health insurance, etc. But then, Neil, my question is that at the same time, you hear other figures, from very sober economists or watchers of the economy like Mahesh Vyas, Center for Monitoring the Economy. And he's put out a figure which says labor participation is at 40.8, which is the lowest in about 40 years. Employment, unemployment is at its highest. According to him, the government contests it, but says almost 430 million people have fallen out of the workforce. So the MSMEs are in trouble. So when everything that we are speaking of is like where the government is placed. But I'm asking you that when you hear all these figures, is all the optimism you're feeling only in the formal economy? And are we, this huge informal economy, is feeling pain that is not even being measured or is not part of the discourse on TV or in conversations like ours? So is it just unmeasured pain? And maybe there's a lot of welfare. So there's subsistence living. So there isn't protests. People are getting their basic dal chawal roti, but there isn't jobs, there isn't aspiration, there isn't growth in the informal sector. Is that a huge cause of worry?
Sure. So I think there are many questions in what you asked. So let me first sort of mentally jot down the big ones. So the first is the process of formalization. Is that good for the economy or bad for the economy? I think I'm oversimplifying your question, but I think that's an important one. The second is that is there a drop in labor participation or worker participation in the economy? And is that a source of stress and will it become cause for social unrest? The third is that I don't think that 430 million drop is the number, right? I mean, I think what perhaps, because total workforce as per CMIE, I think is about 410 million people, 410 million workers. In fact, the periodic labor force survey of the government also estimates it about 500, 550. So it can't be a drop of 430, right?
Okay. But I just read that again, like I said, because one is just reading figures and you keep trying to collate it and seeing, once also read that female participation has dropped from 26 to 16%. So that does mean a lot of disappearance of people from the workforce, I don't know what these millions and millions are anyway. So yeah, what do you...
No, I hear you. And in fact, so that's, I was actually anyway going to bring that point up, right? That FLFPR, the female labor force participation rate, is actually quite abysmal. And it has been dropping now for like 15 years, and it's something that we need to do something about, right? So let's start with the formalization process, and we'll come to what is the job market and what are the various data points, and then the FLFPR. So, see, suppose there are jewelers, right? So let's take an example of an industry, let's say jewelry industry. And there are these, small jewelers in every small market, mostly informal. And I'm not saying all are using smuggled gold, but, there is, the gold is hard to track where they get it and all of that, and very cash-based, right? And suppose during the lockdowns, this was taken up by all of those new age jewelry chains, right? So some very large listed ones, even small unlisted ones, but formal chains. Is that good for the economy or bad for the economy, right? So that's the question. I think it is good for the economy. And the reason is, while it is, I think, terrible for the people who are suffering, but I think the first error perhaps people make when deciding on this is that this is all job loss. This is not job loss, right? So if the business of providing jewelry to people is, if it suddenly, it leads to a 30% job loss, you're talking about a labor force productivity going up by 30%. Right, so that the same number of people in formal jewelers are able to meet the demand of the Indian consumer with 30% less people in the industry. Basically, all the informal guys have gone. So the reason why this share gain is happening is because the formal guys are expanding, so they're creating more jobs. Right, so when someone says that suddenly the industry has shrunk and number of people,
I want to just stop you there, Neil. That when you say productivity goes up, people's profit may go up. That doesn't mean more jobs are being created.
No. Okay, so yeah, so I'm glad you asked that because it is an important question. See, if you take a example even closer home, right? So let's take the example of a restaurant and food delivery, right? Now, when you when someone eats in the restaurant, there is someone to serve, right? The chef is still the same. The food cooking is still happening. Someone is delivering inside, right? So there is a waiter to do that. Instead of that, there is a delivery boy. Now, that delivery boy, whether it is hired by one of the by the restaurant itself or by one of these food aggregators, the apps, is irrelevant, right? From a macroeconomic perspective, that job is the same. I mean, whether he's getting paid 15,000 or 8,000 or, that's a different debate. The question is that a job is still there. So when I say that if there are, say, for argument's sake, 5 lakh people working in India in the jewelry industry, and they were, say 3 years back, suppose, if today in a largely organized setup, are we saying that only 3.5 lakh people will be able to meet the jewelry demand of all of India? I don't think labor force productivity in any industry moves that fast. Right? It does not improve that fast.
Neil, I'm a bit lost over here because when you're saying formalization of economy, like how is this pertinent to the question I asked? Because the formalization of economy means more people are being brought into, say, the formal exchange of money, formal exchange of employment, so it's being mapped.
So the formal jewelers, I'm just using that example, the formal jewelers, because they have gained share, they have hired more people.
No, I'm sorry, I'm not getting the point of how this relates to my question on unemployment or massive drop in labor participation.
It is exactly that, right? So when people say that the informal sector has suffered, the informal sector has lost share, and because of that, there is unemployment.
Share. It's not, people are not saying that it's lost share. It's that there is pain in the informal sector, that we are mapping. All the optimism you're saying is in the sectors which show up either on the markets because they either.
Okay, fine. So let me explain to you what India's GDP as per CSO is about 42 to 44% informal. Okay, about 16% of that is agriculture. So agriculture, there is very little formalization, so we can set that aside. So that remains with about 28%. Right? 28% of India's GDP is non-agricultural and is informal. Right? I think about 12 to 13% of GDP is retail, wholesale, repair of motor vehicles. I don't think there is any great formalization there, right? So there's been some e-commerce gain, there is some modern trade gain, but that's a slow and gradual process. I don't see that as having changed a lot. If you're talking about manufacturing, right? So suppose, which is where I brought in the example of jewelry, because that's the most obvious example everyone quotes. it is in those sectors. So those sectors would be contributing to maybe 3 to 4% of India's GDP, where formalization has actually happened, right? And even there, my argument, and that's what I was trying to explain, is the argument that somehow that has led to significant job loss is hard to understand, because in any industry, if your demand has to be met, unless the formal industry is like 50-100% more efficient than the informal sector, the number of jobs is the same. Instead of working on their own, they are now working for a formal company. So it's a shift. It is not a loss, is the point that I'm making.
No, so then my simple question to you would be, why would it, I'm probably not understanding the point you're making, but I'm finding a gap here, which is that if people shift into the formal economy, where they're actually getting jobs, they're getting pensions, they're part of a formal company's employees, permanent employees, or whatever be the mapper, then you would see an increase in formal jobs. Whereas what we are talking about is not that there hasn't been, from what I know, there's no massive spike in jobs.
Okay,
in
fine.
fact,
So
what we're talking about is unemployment.
Okay, hold on. So let's then. So now, the question that now I understand that you're asking is slightly different from what I was trying to answer. Let's take the job losses, right? So even the CMI surveys, right? So the CMI surveys, if you compare the pre-COVID level to now, where are the job losses? There are job losses in services, there are job losses in industry. In services, which are the largest percentage or the by number of job losses are basically in three segments: travel and tourism, personal services, and education. Right? Now, travel and tourism, until the point that inbound travel picks up, right? So before COVID, $16 billion actually was what the foreign tourists spent in India every year. Now that's close to zero. Now it is starting now. I mean, I hope it picks up very fast. So that all the jobs of small taxi drivers, tourists, travel guides, travel agents, all of those jobs are stuck because this travel is not happening. Second is education, and was education. So even Kerala has only just restarted schools about 10 days back. And remember that 35-40% of India's students went to private schools where fees are less than 1,000 rupees per student per month. And if you take a PTR of 20, so pupil teacher ratio of 20, the total fee per teacher as to school gets, if you're say paying 700 rupees, is 14,000 rupees. These are teachers who got paid 8,000, 6,000 rupees a month, and they've been without jobs. Right? And then there are personal services. The personal services are office boys. So even today, only half the offices are fully open. There are maids, drivers, and as the schools restart, as the offices restart, these jobs are coming back. If
I just cut in here, because there's some more questions
sure, yeah.
So then you're saying that this is a temporary. So that point you made at the beginning,
temporary, and it will, as the economy opens up, I think these jobs are coming back.
You're saying it's not a permanent scar. This was more a circumstantial scar, and the government calculated that this pain can be offset by delivering rations and etc., and that it'll all bounce back as things start opening. That these are not.
And a measure which I think is much more reliable than most surveys, though I think CMI surveys have been a godsend when in the last 2-3 years, as there's been a dearth of data. But I think a much more reliable indicator of joblessness is NREGA. So NREGA was showing significant stress a year back, even 6 months back. The numbers are still elevated versus pre-COVID. So as I said, the increase versus pre-COVID was 2 crores at one point. It is now 20 lakhs in April. And my expectation is in the next 2 to 3 months, it will fall to 5 to 10 lakhs. So there is some scarring, but in a workforce of 500 million people, if you see an extra job loss of say 500,000 or 1 million, it is terrible for those 1 million people. But I think as at a macroeconomic level, it is not something that is very damaging. And I don't think even that will remain given the pace of revival. So say as construction picks up, a lot of these jobs are going to come back.
Okay. So just before moving to a couple of other things, so now everything else that you were saying, that all the measures, we're going to run out of time, but some of the other measures you're saying which are being taken now to control inflation, which will decelerate growth. Do you think that this recovery that you were talking about, like what is the, would you just give me 1 second, please, Neil, just a minute. So if you were to not commit yourself, but, again, being an analyst, what is the time frame of pain that you think India is going to go into? Like what is, if you were looking in the crystal ball, how much pain and which sectors will feel pain, and how long do you think this pain will last?
Yeah, so let's see the source of this pain, right? So we import 48% of our dense energy needs. And as it's very easy to explain that you cannot have GDP without using dense energy, right? And the fact that we are now importing coal at $300 per ton, over and above the oil, which everyone talks about, is actually a huge burden. So fertilizers, edible oil, like the edible oil we import has gone from 10 billion to 20 billion, and that is a drag on growth, right? So if say when something which is local and prices go up, right? Say onion prices go up. So you and I pay more, but the farmer benefits. He can then spend. When you pay more for imported coal, when you pay more for imported oil, you are exporting savings. And that is a drag, which is a very unfortunate side effect of what has happened in Russia, Ukraine. Now, before this happened, consensus GDP growth for FY23 was at 9.5%. It is now at 7.4. So the 7.4 is already incorporating the pain that is coming from the energy imports becoming more expensive. Yes, and so I was at 12.5, 13. I'm at about 9.5 now. So I've also brought down my growth forecasts. What I'm just saying is that my growth forecasts are better than what my peers are forecasting. What can be done to soften the blow? And I think some of the measures, like the fiscal measures that have been taken, like the cuts to excise duty, the subsidy for fertilizers, because if fertilizer costs start going up, then the inflation cycle, the inflation expectations, and the second order effects become very brutal, right? So fertilizers are used across crops, vegetables, fruits, cereals, pulses, oilseeds, everywhere. And then the inflation then starts to become a lot more sticky. I still think that fiscal interventions to control inflation only push it over time. They don't sort of eliminate it. But as I was saying earlier, I don't think there is an easy solution to suddenly your import bill on energy going up. I think the better solution would be to bite the bullet, let the rupee fall a bit, let imported prices go up in one shot, and then see where the economy settles.
So, just to round off, there are a couple of things that I'd wanted to ask you, which the government seems to be doing right in the long term, which is the shift to green energy, this huge focus on technology. It still seems to leave a large part of society out of its ambit, but you have to start somewhere. So, those are fine. But just vis-a-vis, that other question that we left unaddressed, you said, if indeed there are huge unemployment figures, it's a recipe for social unrest. If just in short, are you basically saying that this fear of massive unemployment is misplaced? There isn't such large unemployment figures?
See, that is why I keep getting back to NREGA. Other than that, there is very little which is reliable, right? So many surveys of jobs there have been questions raised on whether the sampling is correct. And, there are many questions raised. But NREGA is a demand-driven scheme. I mean, it's a right, and most people now understand that right. So if they are, the worry is, of course, that if there are 20 lakh extra people willing to work for 200 rupees a day in the hot sun, there must be 1 crore extra people who would be willing to work for 400 or 500 rupees a day, right? But But what I'm saying is that sequentially, those numbers are coming down. I think the FLFPR challenge is a structural one, and I think we need to do something about that. That's without doing that, getting close to what the North and East Asian economies have delivered is going to be very hard. The decline in FLFPR, I think, based on some of the academic studies, it's mostly happening at the low income segments because the people who worked there were working out of desperation, meaning in very poor working conditions to be out there, and once they reach a certain level of basic sustenance, then they would prefer not to work. And I think getting them back into the workforce in a much better working environment has to be the biggest policy challenge, perhaps, for the next decade or so.
Okay. And so just, now the other sort of point of worry that one keeps reading in the news is that there's this K-shaped recovery. Now, a lot of that you've been saying actually refutes that. You've been giving examples, but people say that there isn't really much private investments happening. Corporates are not investing, that there's a huge amount of profit concentration. One has been reading very alarming figures of how much wealth profit concentration there is, and is not even being plowed back into the economy. Now, there again, do you think these are just false alarms, or is that really happening in our economy? So you've explained what the government is doing to create stimulus and XYZ, but then why is there not private investments?
I always get surprised when I hear that comment that private investments are not happening. So, in the government statistics, if you look at gross fixed capital formation, which is the proxy for investments, they give three heads. And in all of GDP, you can actually look at private corporate, which is the corporations, there is public sector, which is the government sectors and PSUs, and there is the household, which is the residual, right, the informal sector and all that. What you will see is that private corporate capex actually has been growing in line with GDP from, say, 2015 to 20, which is the last data we have. We don't have 21 and 22 split in that granularity. In most sectors, I think what has also happened, and which people now need to get their heads around, is that investment now needs to be a lot more intangible. See, since the 1990s, in the US, for example, capital investment has become more intangible than tangible. So it's less about factories. It is more about software, about billing systems, about customer relationships and all of that. And even in India, if you look at GFCF data, so more than a third of GFCF by corporates now is actually software. Because, having
what is that acronym?
GFCF, gross fixed capital formation. Right. So, so there is gross capital formation, which includes working capital, inventory, etc., and there is fixed capital formation, which is actually the investment. So in GFCF, if you see, and I'll share with you a report after this, that the investment in software, which they call it IP, but actually IP mostly in software in India's case. So I think the perspective that corporates investing for future growth necessarily have to build a lot more of plants and machinery is something that needs to be questioned. That they can be, like, the largest companies in the world today, don't own any factories. Whether India should be going down that path or not is a different question. But it is wrong to say that the weakness in GFCF has actually come from what I mentioned earlier, which is the household sector and the weak investments in real estate. Because the real estate down cycle was on, and that is why cement volumes have been very weak. Long steel product volumes have been very weak over the past decade or so. But as the inventory correction gets over, as the real estate cycle starts to turn, I think you will see some of those things start to turn as well.
I think I'll have to stop there, Neil, because we've run out of time. Just literally, if in one line, if you could
Sure.
respond to just household pain. I hear our staff, you go in a taxi, everyone's talking about mehengai, So when we are trying to reduce demand, of course, it'll slowly bring down costs. But in the short term, that's what I was trying to ask you for a time frame that, this high cooking gas, high fuel, high vegetable costs, high milk costs, all this. What sort of time frame do you see this sort of continuing? And
No, I think it takes a while because the world over demand destruction is not happening because every government is subsidizing it. So what happens when prices go up, right? Suppose there was 100 of supply and 100 of demand. Now there is 90 of supply and 100 of demand. So 10 people have to stop consuming, right? That's the basic reality. And everyone keeps bidding higher and higher price. And that is why oil prices have gone from, $75 to $120. And if this continues like this, I think they may go to $140.
Input costs on everything are higher, is what you're saying.
Yeah. So and so unless that you see some lifting of sanctions, you see addition of new oil supply, new coal supply, I don't think this is something that is very global in nature. I think someone was saying that they were talking to their relatives in the UK and they had their sweaters on and basically they switched off heating because heating has become very expensive. So it is very painful, but I think the outlook is very uncertain on this.
Thank you very, very much, Neel. That was a very, it was so refreshing because it's devoid of rhetoric, given with a lot of evidence. So anyone listening to this interview, and if they have to refute you, they'll have to provide their own evidence on it, not just rhetoric. That is a big deal. So thank you very, very much, Neel. It was a real pleasure talking to you.
Thank you for having me on the show.